Anthony Chan. Anthony is the former chief economist from JP Morgan Chase, 25 years there on analysts and research, and also on JP Morgan's Global Investment Committee. Good to see you again, Anthony. How are you?
Great. Good to see you, Phil. Happy to be with you.
Yeah, it's fantastic to have you. What the hell happened? They were expecting 75, they get 50, and they seem to be so happy. What did the market get wrong?
Well, I think the markets like certainty, and they certainly didn't want to have a Federal Reserve that would move in so aggressively that it would guarantee a recession. I think that Chairman Powell said it best when he said their goal is to get a soft or softish landing, which means that he's willing to risk a mild recession if you read him between the lines, but he preferred not to. And I think that the markets were cheered by that because remember, if you get a recession or a deep recession, that means that it's going to take a real big hit to corporate profits. And that's something that certainly stock investors don't want to see.
Last quarter, we already saw a decline in the economy. So we're halfway to a recession already. I don't see how this is good news because you could argue, well, a minor recession, but the impact on corporate profits is critical. We have a crazy situation with the labor force. You have running away prices, and you have questionable situations throughout the world on the macro front. How is this good news?
Well, Phil, I just wrote an article on Substack on that topic, and when that 1.4% decline in GDP came out, you have to think about what are the components and what really was driving that. Consumer spending was robust. That's 2/3 of the economy. It was up 2.7%. The real reason why you saw that kind of weakness was because inventories were drawn down. That subtracted 0.8%. But when you draw down inventories, that means there's excess demand. And then, of course, net exports subtracted again some more. So the combination of net exports and inventories subtracted 3.6%. And remember that when net exports are subtracting, that means that we're importing a lot more. And we're doing that, Phil, because we can't satisfy the pent-up demand with all the products we produce here. So the composition that led to that decline is important. And it did not in any way suggest that we were in a recession at the moment. The second piece, Phil, was that technically, when you see a recession, you see consumer spending weak, which it wasn't, and you see business investment weak, and it wasn't. It was up 15.3%. All those reasons suggested that even though you had a weak GDP numbers, that composition told you a different story.
But Anthony, remember when we used to watch retail sales and we would say that, well, when sales are high, the government needs to step in and squash it with the inflation, and when sales are low, that's when you cut rates. Using what you just told me, if demand is still high, the consumers are still healthy, doesn't that mean the Fed has to continue to be aggressive?
And they are being aggressive because remember, over the last 20 years have been accustomed more to 25 basis point increases. And today, Jay Powell increased rates by 50 and told you there may be 2 more 50 rate hikes on the table over the next 2 meetings. And by the way, by the end of the year, the upper limit of that Fed funds rate will be close to 3%. I'm not sure that's enough, but it certainly was enough of a first step, an initial step, that it kind of comforted the equity markets. I think they'll have to do more than that. But certainly by the end of this year, 3% at the top end of the limit is certainly a pretty reasonable start for the equity market.
You've got gas prices up, what, 40, 50%. Airplane tickets are up 100%. Hotels are up 100%. I mean, it may not be true, but that's how it feels, okay? What can Biden realistically do about it besides just raising interest rates?
Well, at this point, the central bank or even the administration cannot do much because you got to remember that policymakers can influence demand, but supply, which is being influenced by a lot of the factors that you pointed out correctly, those are not in within the control of the Federal Reserve. So if they can't boost supply so that price pressures go down, guess what they have to do, Phil? They have to reduce aggregate demand, and that's what they're doing. They're throwing their hands up. The fact that 30% of wheat is produced in the Ukraine and Russia, and a lot of that supply is going to be constrained. They can't do anything about that. The fact that we have supply chain disruptions because there's a slowdown due to COVID in China, they can't do anything about that. So they can only control what they can, and that's aggregate demand.